the economy is a lot slower than what people thought, which, to your point, the silver lining is that it probably now tips the balance of action in September to a cut. And if it was 25 basis points, there's probably going to be a lot of folks lobbying the Fed to cut 50. And I think that they probably have enough numerical justification now to cut 50. I think the bigger problem, though, is if you don't have an accurate sense of where employment really is, and Sachs did mention this, you will also then have an inaccurate sense of where GDP is. And I think the 1-2 punch could be very problematic. I think what we're learning more than anything else is we have a very sophisticated economy. We have a very sophisticated capital market system. We have very sophisticated actors in those markets, all of us included, who can react to real-time data and make the right decisions. The problem is we have bad data. And the bad data, I think, is something that is fixable, but we need to make an effort to do it because it's insane that the largest and most sophisticated economy in the world is this unpredictable. And I think that's like the big question that I have, which is how is it possible in 2024 that we haven't just made this a priority to fix this? And with all of the systems that exist and all of the SaaS tools that exist and everything that's used to like hire and fire and pay people, we don't have an accurate sense of this number.
These kinds of things, so I've never done them. And part of the reason why is I think these things look genius and they work until one moment in time where they stop working, and it stops working so severely that it becomes almost impossible to unwind yourself. And so you can get
unwinding,
caught. Yeah, so I think typically in these situations, the thing you have to remember is you don't really make a lot of money in this trade. The way you make a lot of money is by leveraging this trade up. So meaning, it's not like borrowing $1 million in yen and then swapping it to US dollars and then putting it in T-bills is a real moneymaker. You're talking about 50K. That's not really going to move the needle. So what people try to do in these situations is do it on $1 billion and then lever it up 5 or 10x. The problem with that is that you're posting all kinds of collateral as margin to these banks to give you that leverage. Because then all of a sudden, capturing 150 basis points on 10 billion or 15 billion, now we're talking about real money. And so when these things go wrong, and they happen very suddenly, what it does is it puts pressure on all other asset classes because people are scrambling to make sure that they don't get margined out. And what you saw over the weekend was it mostly a lot of that happening, which was a lot of these folks were putting this trade on to the tune of tens or probably even $100 billion plus dollars.
Wow.
Of which they had maybe 5 or 10 billion of equity and 80 to 90 billion dollars of just margin. And that's what caused this very quick cycle. Then it looked like it unraveled itself. And so people thought, oh, we're probably mostly past this. I actually think we're not. I've said this before. I think one of the most interesting things I've learned in the last few years about the stock market is the stock market is owned by and large by these algos, right? Meaning there's these large kind of murky grayish hedge funds that have these computer trading algorithms that are allowed to be levered to the tune of, 13, 15, 20 times about $50 billion. So these folks are swinging around $1 trillion each, okay? And we all just live in their world because when these algorithms make a decision and they react to these kinds of events, that's when the real volatility starts. So I think the most important thing was summarized by friends of ours from Goldman Sachs. I just want to, Nick, if you want to just throw up the picture that they sent me. So they sent some really good market insights whenever these things kind of happen to a bunch of their clients. And one of the interesting things that they observed is a couple of facts. The first is the algorithms in the middle of all of this chaos sold about $41 billion of global equities. Okay, no big deal. Except that it actually causes everybody else to have to react, and then they sell billions and billions more. The other thing that they noticed, though, is that we're in a moment in time where you can see how these algorithms will behave over the next month. And right now, if there's relatively minimal volatility and not much changes, the algorithms will have to sell another 160 odd billion dollars of equity. And that'll pull through many hundred billions more from everybody else. So I think we're in a little bit of a delicate moment where the preponderance of the market action will be to continue to sell. And I think it's just going to be, when we look back in hindsight, another reason why getting levered on these things is very dangerous. There's no free money, basically. Greg Abel have already talked about the kind of risk book that they want over these next 5 to 10 years. And it reflects a discussion about what the incoming CEO wants. So there could be all kinds of reasons why. I don't really know. I just think that Apple, just back to Freeberg's core thesis, I agree with many of his general points. I'm not sure that they affected the Berkshire strategy, but Apple is sort of a little bit wayward. It is a company with an effective and unregulated monopoly or duopoly that doesn't really know what to do. And I think that that's the biggest problem with that company. And that's independent of Buffett selling now or selling a year from now or having not sold the year before.
Well, I think 2020, you have to put it a big asterisk, because the question is, what would have happened had there not been COVID and had there not been an entire global shutdown? So if you go back to that chart, you could probably just extrapolate and cut out that part that's flat, because the part that's flat from 2020 to 2022 was largely artificially created, because on top of that, we injected so much money into the economy. The reality is we probably would have raised at some rate of change that you could have predicted from 2016. So what do you take away from that? I think that you have to realize we're at a point in the economy where you cut rates because there's tension. And there's tension between employment and unemployment. There's tension between earnings, growth, and contraction. And so it's a stimulatory move. So if you look through that stimulatory move, why is the Fed doing this, and why will they cut probably all the way down to 2 or 3% by the end of 26? It's because we now need to stimulate the economy. So the reason why markets tend to fall once the rate cut cycle starts is because the next couple of quarters sort of demonstrate what I think the Fed is expecting, which is that there's pressure in the economy. We have not seen that flow through in earnings or in how companies describe markets on the field, by and large, except for a few. So I think this part of the cycle now will be about all of these companies telling us whether there's nothing to see here or whether there is actual real pressure. And if there is real pressure, it'll probably look like the several times before, where you're just going to have to contract the value of financial assets because they're just not worth as much when they're earning less.